Good afternoon, students. This is Professor Buchholz coming to you live for Accounting 446. And today's conversation is going to take us to partnerships, formation, operation, and ownership changes. So a couple of learning objectives. The first, describe the characteristics of a general partnership, a limited partnership, and a joint venture. List some important items to be included in the partnership agreement. Understand the differences between partnerships and corporations' equity accounts in the balance sheet. Explain the purpose of the partners' drawing accounts and capital accounts. Prepare journal entries to form a partnership using the bonus and the goodwill methods. Describe some common agreements used to allocate partnership net income or loss. Explain why salary allowances and interest allowances are used in allocating partnership profits and losses. Describe the methods used to record partnership changes when a new partner is admitted or when a partner withdraws from the partnership. Describe the rationale behind the goodwill method in accounting for changes in partnership membership. So let's talk about partnership accounting. Most of your career in accounting undoubtedly has been the normal corporation setting. And this changes gears a little in that we're not talking about a corporation, we're now talking about a partnership. And a partnership has a straight definition that says that it's an association. It's an association of two or more persons to carry on as co-owners of a business for profit. So therefore, a partnership can never really be a not-for-profit. So again, a partnership can be a partner, a corporation can be a partner, but not really a not-for-profit. What are some other attributes? There's usually an agreement in articles of co-partnership. Articles of co-partnership. And those articles of co-partnership are very explicit with regards to an agreement, who is going to be making a profit, and how they make said profit. And usually the members are all co-owners. Why do you want to form a partnership? That's a very good question. First of all, it permits the pooling of capital and other resources without complexities and formalities of a corporation. Two partners wish to get together, no legal red tape, so to speak, like a corporation, so let's just get together and pool our assets. Easier and less costly than a corporation. Not too much government regulation. Partners are also able to operate with more flexibility. The income, if you're lucky to have income, is not subject to taxation at a partnership level. Instead, it's really being taxed on the individual level. So again, the tax treatment, usually the partnership will file as a 1065, which is an informational return only to the government. The income or loss is then given to the individual partners, what's called a K1. We're going to talk for a moment about the general partnership. And in the general partnership, each member is a general partner. Mutual agency. When you put that money into the account, it belongs to the other partners. When you put fixed assets into the account, it belongs to the other partners. Right to dispose of partnership interest. Basically, if a partner wants to get rid of another partner, there isn't a way to do that depending on the partnership agreement. There is unlimited liability. Meaning, in a general partnership, if somebody wants to sue, they may sue any and all of the partners. Limited or uncertain life. Partner passes away, the partnership is said to no longer exist. Now, newer form that we're quite well aware of with public accounting firms is the limited partnership, where I've got one general partner, one limited partner. The general partner may manage the firm and is liable, and typically, folks, they're going to have a little more compensation, a little more of a bonus, some sort of incentive. Whereas a limited partner is going to invest capital only, have limited liability, and usually no participation in management. It depends. Again, it does depend. Joint ventures, usually it's an arrangement, this is typical of a partnership, arrangement by two or more parties to accomplish a single or limited purpose for a mutual benefit. So again, this is not going to be a business that's around forever. Maybe it's just for a specific project, governed by a written agreement, commonly organized as corporations or partnerships. Partnership agreement. When you go into business with a partner, ladies and gentlemen, you must have an agreement in writing. It's recommended. If not, ladies and gentlemen, if you don't have something that tells you the name of the firm, identity of the partners, what's the purpose, how long is the organization to operate, the location, the provision for allocation of profit and loss, salaries and withdrawals, the rights and duties and obligations of each partner, the authority of each partner. Now, if you don't have a written partnership agreement and you go to court, the judge is going to rule 50-50 in the absence of said agreement. What else should your agreement include? How to admit a new partner. Procedures on withdrawal or death of a partner. Procedures for arbitration of disputes. Fiscal period of partnership. Identification and valuation of initial assets. Situations for partnership dissolution and provisions for terminating. What accounting practices are we going to follow? Do we or do we not need an audit? Capital interest versus a profit interest. Capital interest is a claim against the net assets of the partnership as shown by the balance in the partner's capital account. Interest in income and loss is how the partner's capital interest will increase or decrease as a result. So as we earn money as a partnership, maybe as we lose money as a partnership, we're going to be giving that out to the individual people. Those individual people need to know how to account for their income. Let's talk about accounting for a partnership. Partnerships generally will adhere to GAAP. And we're going to assume the use of GAAP for partnership accounting. If you're a very small partner, you may utilize cash basis, a little bit easier, or tax basis accounting. A partner's interest in net income or loss, ladies and gentlemen, may not be the same as their proportion of the respective capital interests. And you would say, Buckholz, why? Why would that be the case? Why would anybody agree to such a terrible thing? Well, the answer to that is very straightforward somewhat. Maybe one partner is going to put more in but do less. Maybe one partner is going to put less in and do more. Again, how do we know? Be in the articles of copartnership. Partnership's equity section normally would consist of a capital account. So again, we're typically used to seeing common stock. Here it's going to be capital. Another account is a drawing account, which is typically debited to record withdrawals of assets in anticipation of profitable operations or payments. A drawing account, if you want to draw an analogy, is like a dividend account. We do not have dividend accounts. We do not have common stock in a partnership. Drawing accounts are closed periodically to the capital. In partnership accounting, believe it or not, most likely on an Excel spreadsheet, there's one capital and one drawing account for each partner. Let's take a look at this first exercise here, where these two people form a management consulting partnership on 1/1/14. The fair value of the net assets invested by each partner are as follows. Now, during the year, Tom withdrew $15,000, Julie withdrew $12,000. Net profit $50,000, which is to be allocated based on the original net capital investment. So the first thing would be is to prepare the journal entries to record the initial investment in the partnership for Tom. You'll notice it's being recorded as fair value. Please note, GAAP requires fair value. Those of you that may be taking a tax class will learn a little bit different how they do it on a tax basis. These are the entries we record for Julie. You then will record these withdrawals. Debit Tom drawing for 15 and credit cash. Debit Julie drawing for 12 and credit cash. Again, conceptually, try to think of it like the dividend accounts in the corporate world. The third is to close our income summary, profit and loss, and the drawing accounts. According to the fact pattern, we had a profit of $50,000. This 50 is to be split between Tom and Julie in the respective capital. Since Tom gave 51,000 of the 76, he obviously is getting more capital put into his account than Julie. So of the $50,000, 33,553 went to our friend Tom, while 16,447 goes to Julie. We then close out Tom's capital account to his drawing account, and the same with Julie's capital account as well. The next question is, how do we allocate net income or net loss? Well, one way to do it is based on capital balances we just saw. Your partnership agreement should include how they're allocated. Again, in the absence of this in writing, the courts will rule 50-50. For the purposes of homework, exercises, and exams, we will assume that as well. In the absence of an agreement, 50-50. You're going to see that a lot of times people do it based on fixed ratios, ratios on capital balances, interest on a capital balance if you keep it in there, a fixed salary allocation, or a bonus. So let's look at a different exercise here. That we have these two who have invested capital. We have a partnership agreement that provides that profits are to be allocated as follows. The salaries, a bonus of 10% of net income after salaries and bonus, but before interest on capital investments is subtracted. Each partner is to receive an interest credit of 8% on the original capital investment. Anything left is a 40-60 ratio. Assume 188,000 was net income this year. So the first thing is, let's calculate the allocation of the bonus. According to this, the bonus calculation is 10% of net income after salaries and bonus. So if we set up this algebraic formula, what we're saying now is the bonus is going to be 10% of the income after salaries minus the bonus. And then through some algebraic manipulation, which we've seen before, our bonus is 7,273. Which is very interesting because what they're really trying to do over here is kind of shortchange this particular partner, giving him very exact what the bonus needs to be. Why are they doing it? It gives the partnership an incentive to get that profit up. So now, how would we allocate the 188,000? That's all we have. Well, we have a salary. So when we put the salary on our schedule, we've taken up or used 108,000 of the 188. A bonus was given to John of 7,273. And there's interest on their beginning capital, 38,400, which again, remember, you have 10%, 8%, I'm sorry, of the original capital, so 8% of 480, 8% of 340 is 65,000. Well, according to this, we have 180,873. But we have a remainder, meaning money left to allocate, of 7,127, leaving us with an income allocation of $188,000. The 7,127 is split between the two partners in the 40-60 ratio. So for the year 2014, Tony's going to get 83,251 allocated to his account, and John 104,749. What happens if I don't have enough income to allocate? Anything that exceeds that net income is just reducing the partner's income, the partnership's capital account. Let's change our fact patterns and see what we come up with. New partnership of Adams and Brown, give salary, give interest, and a remainder. $11,000 is the income. Salary is 4,000 and 2,000, giving us 6. The interest yielding 9,200. You have $15,200. But I only have income of 11. The 4,200 excess is then divided amongst the partners in that equal range. Remember, you can only have what you started with net income or net loss. So what are some problems in the allocation of income and loss, salaries and interest as an expense? Some change in capital accounts as if salaries and interest were considered an allocation of profit. Since the normal practice is to recognize salaries and interest as an allocation of profit, any such amounts treated as an expense should be disclosed. This way, the statement reader can properly evaluate the operating performance of the firm. Adjustments of income in prior years. Problems in allocation of profit and loss can result if errors are discovered that occurred in specific prior years, and partners have altered the profit and loss agreement since the period in which the error occurred. Corrections are allocated to partners' capital accounts. The allocation should be based on the profit or loss agreement in effect during the period of the error. Financial statement presentation. Partnership do give financials. Some differences from normal GAAP that we've seen in the corporations. Number one, changes in partners' equity should be disclosed. Number two, salary allowances in a partnership to the partners are not an expense. I'll repeat that. They are not an expense if you're a partner. These are allocations of net income. There's generally no income tax expense. Interest is paid to a partner on a loan balance is an expense. Interest allowance on capital investment is considered an allocation of profit. So if we looked at a statement of changes in partners' capital for the year ended December 31st, 2014, this is how it would look. The capital, the additional investments, the net income allocation, less withdrawals. Sometimes in a partnership, ownership changes. The UPA, or the Uniform Partnership Act, defines a dissolution as, quote, the change in the relation of the partners caused by any partner ceasing to be associated in the carrying on as distinguished from the winding up of the business. A dissolution may be voluntary, mutual agreement, or involuntary, but it does not automatically result in termination of business activity. When there is a change in the membership of the partnership, the problem of assigning a fair value to the firm arises. One method in terms of doing this is the goodwill method. Under the goodwill method of accounting for changes in partnership membership, the capital interest assigned to the new or withdrawing partner implies a certain value for the firm. Since the records are maintained on historical cost, differences in net asset values are likely. Significant intangible assets may be created over time. The goodwill method assumes that the assigned capital interest provides a total basis for valuation. Now, this is a method used in partnership accounting, but ladies and gentlemen, this is not a method that GAAP appreciates. U.S. GAAP generally does not like this particular method. Methods of recording changes in membership. Two methods are frequently used. The first is the bonus method. Assets are increased by the amount of the assets invested by the partner being admitted. Any difference between assets invested and credit to new partner's capital account is adjusted to capital accounts of other partners. We may want a new partner to come in, and we're willing to kind of take our old partners and give a new partner a bonus. Why? Maybe this new partner is going to bring in a great big book of business, has a name that we really need. The goodwill method, a new asset is recorded based on the difference between the value implied by the amount of consideration and the values reported in the partnership books. Let's take a look at this particular exercise. Exercise 15-7. Phil Phoenix and Tim Tuscan are partners in an electrical repair business. Their respective capital balances are $90,000 and $50,000, and they share profits and losses equally. Because the partners are confronted with personal financial problems, they decided to admit a new partner to the partnership. After an extensive interviewing process, they elect to admit Don Dallas into the partnership. Let's prepare the journal entry under the following conditions. Number 1, Don acquires a 1/4 of Phil's capital interest by paying $30,000 directly to him. So again, Phil has $90,000. Don acquires 1/4 of Phil's capital interest by paying $30,000 to him. Now, what this means is Don meets Phil outside of work, outside of the partnership, and gives Phil a check directly. This money, folks, is not coming to the partnership. So we're going to give Phil $30,000, but we're only going to get equity of $22,500. So what's going to happen is Phil's going to send around a memo that talks about this change, and what we're going to do is debit Phil Phoenix capital for $22,500, credit Don Dallas capital $22,500. If you examine this journal entry, ladies and gentlemen, what have you done? Hopefully a lot of you are saying nothing. And that would be correct because the capital accounts are both going to remain the same balance. It's just which capital. In the second scenario, Don acquires 1/5 of each of Phil's and Tim's capital interests for $25,000 and $15,000 respectively. So again, 1/5 of each of Phil's and Tim's capital interests for $25,000 and $15,000. Same scenario. We go out, we're done, we take Phil and Tim to lunch, give them a check directly, and we're doing a reclass. Again, we are reclassifying only. No money has come into the partnership. Don acquires a 1/5 interest for $60,000 in cash. Total capital after the admission is to be $200,000. This is a signal. When we see this word, ladies and gentlemen, or this phrase, the total capital after the admission is to be $200,000, it's the bonus method. What we're saying, and here's a good formula to know, Phil and Tim represent the old partners. Old partners. The new one, Don, giving 60. When we add these up, we take this times the percentage, is $40,000. Now, ladies and gentlemen, please note the new partner is giving an amount greater than the book value of the firm. Why? Why does he do this? Maybe Don wishes to be in this partnership because he sees opportunity. So he's willing to pay more in the hopes of getting more later on. So we would debit the entry, debit cash of 60, credit Don Dallas capital of 40. Now again, hopefully you notice a $20,000 difference. Well, who's getting that 20? It's a bonus. A bonus to who? The old partners in a 50-50 ratio. So now Phil and Tim's capital both go up. Assume that Don invests 1/4 for a 1/5 interest in capital. Goodwill is to be recorded. Don's investment is $40,000. The interest in the partnership is 20%. So Don's investment is $40,000. We have an interest we wish in the partnership of 20. That means the total capital of this partnership needs to be 200,000 if I take the 40 divided by the 20%. Because again, that's the capital that I am investing. Well, so far the capital here with Phil is 90, Tim is 50, and Don is 40. Well, the total capital needs to be 200. I have already got 180,000 when I sum these up. That means I have a goodwill balance of 20,000. But who gets this goodwill? We debit cash for 40 and credit Don Dallas's capital for 40. A second entry is done to debit goodwill and asset of 20. Yep, and these guys get it as well. This method is revaluing the asset to maybe show that there's a goodwill from these partners who are already there. Maybe their business life, maybe the products they've done. That's basically what that represents. Assignment of an interest by an existing partner. A partner is entitled to sell his or her interest in the firm, but no partner can be forced to accept a new member to the partnership. The purchaser does not acquire the right to participate in management unless everybody agrees to give this right. The mere act of selling an interest does not dissolve the partnership because the overall relation of the partners is not changed. There are three situations that we have to be aware of in this class. The first is when the fair value of the assets we're giving is equal to that book value. In that case, there is no bonus or goodwill. Second scenario, which we just saw, is when the fair value of the assets invested are greater than the book value of the capital interest. The bonus or the goodwill will go to the existing partners. If the fair value of the asset is less than the book value of the capital, it means the bonus or goodwill is going to the new partner. So I would say this is a slide I would definitely star and come back to when I was doing my studying. Looking at exercise 15-9, let us assume that these partners have been operating a small gift shop for several years. The partners concluded that the businesses needed to expand in order to provide an adequate return. Here's the balance sheet. And here's their ratios. We're now going to admit Mary. Mary is to invest sufficient cash to receive a 1/6 capital interest. The admission is to be recorded without recognizing goodwill or bonus. So the question is, assuming this is the case, how much does Mary need to really give? Well, right now the old partners, Beth, Steve, and Linda, have given $600,000 in existing capital. The existing partners, theoretically, if Mary's getting 1/6, the existing partners will have 5/6. So 600,000 divided by 83 will give total capital of 720. The existing capital already in the business is 600. Therefore, for Mary to invest with a 1/6 interest, she'd have to cut us a check of $120,000, which would be no bonus method, no goodwill method. It would be that the fair value is equal to the book value, which we discussed in this prior slide. Assuming we were doing a debit and credit, we would debit cash of $120 and credit Mary capital of $120. Now, assume a new method, bonus method. Mary wants to invest $160 for a 1/5 interest. When we do our computation, $760, Mary is 1/5, the book value is $152. The amount Mary has given is greater than the book value required, greater. So the bonus method of $8,000 goes to the old partners in their existing ratio. The goodwill method. Assuming this was the case, we have Mary's investment of $160. We have Mary's interest of 1/5, so $160 divided by 20% would mean that the capital would have to be $800. Mary and all the other partners are giving $760, so the goodwill to the old partners is $40,000. So debit goodwill for $40,000. The old partners divvy up the 40, and then here's our new Mary for 160. Now assume that Mary is giving this for a 1/4 interest. The book value is greater than the amount invested. Well, this is a game changer. Mary's invested $160 in cash, but it gets $190. Why? Well, these other partners, Beth, Steve, and Linda, really want Mary. So now, in this situation where the book value acquired is greater than the amount invested, that's right, the new partner, Mary, is getting the bonus. Okay, we debit cash $160, credit Mary $190. So now that means we're going to take the bonus from the old partner's capital. Next, let's take a look at this from the goodwill perspective. So again, goodwill method. If the current partner's capital is $600,000, we need to do this a little differently. Mary's going to invest a 1/4 capital interest. We've already determined that the book value being acquired is greater than the amount invested. In this case, rather than doing it by the other method of Mary's 24, the 1/4 interest, we're going to divide it by 75%. 75% represents the current partner's interest. And the reason why we do that is, if I was to show you 1/4, 25%, you'd see that there would be a negative goodwill situation. And that wouldn't make sense for anybody to enter into. So the total implied capital is $800. The total being invested between Mary and the old partners is $760. The goodwill is $40. This goodwill is going to be brought in and recorded to Mary. We'll debit cash of $160, goodwill of $40, and Mary capital $200,000. Section B, the withdrawal of a partner. A partner cannot be prevented from withdrawing from a partnership. It does happen. It is assumed partners mutually agree to the withdrawal such that The withdrawing partner sells an interest to an outside party. The withdrawing partner sells interest to remaining partners, or transfer partnership assets to withdrawing partner. Same type of a deal. We can have a bonus method or the goodwill method. So let's take a look over here at a different exercise. 3 different partners, income of a 4-4-2 ratio. So again, think of it as 4 plus 4 is 8, plus 2 is 10. 4/10, 40%, 4/10, 40%, 2/10, 20%. Tucker decides to withdraw. The partnership revalued its assets from $225 to $252, which represented an increase in the value of inventory of $8,000 and an increase in the value of land of $19,000. Tucker was then given $15,000 cash and a note for $40,000 for his withdrawal from the partnership. So let's prepare the journal entry to record the revaluation of the partnership's asset. If inventory and land went up, we would prorate that revaluation to each of the partners. Step 1. Step 2. Prepare the journal entry to record the withdrawal using the bonus method. Cash was given to this particular partner and $40,000. Tucker, again, who had $45,000 in the beginning and was just given $54,000, is removed for $50,400, and the 2 other partners therefore have to suffer in the bonus in the amount of $2,300 each. Again, 50-50. If we were to prepare the journal entry to record the withdrawal using the partial goodwill method, goodwill would be $15,000 plus 40 minus 50,400, and Tucker would be removed for the 4,600. So again, 15,000 being the cash, the 40,000 the note. His value prior to him leaving, don't forget, was 50,400. So the price we paid him, less what he was worth, gives him an additional goodwill. Tucker Capital is then relieved for 55,000, crediting the cash for 15, crediting the note. Now that's partial goodwill. The full goodwill method, a little trickier. Goodwill is 4,600 divided by 20%. You say, well, wait a minute, what does that mean? 4,600 comes from this number, but we all said before that Tucker has the 20% ratio. So if I divide this by 20%, I would debit the goodwill for 23,000 and credit everybody else in that same ratio, 40 to 40, 20. And then relieve Tucker. So in the full goodwill method, everybody gets a piece of the goodwill. In the partial goodwill method, only the retiring or the withdrawing partner got it. Payment to the retiring partner, less than book value. A partner may agree to accept less than his or her interest for many reasons. They may view the company negative. They may need capital for personal reasons. Or business association may no longer be acceptable. Under this situation, we can use the bonus method. And that pretty much concludes this chapter. Again, a lot of debits and credits and a lot of computation. We recommend that students go through this chapter one more time with the video before completing any and all assignments. Good luck, and we will see you again online.